Hey everyone, Polyplex share price has corrected more than 55% from its peak from 2800 to current levels of 1200. And at current levels, the stock is trading at a P ratio of 7. Yes, you heard that right. In last 1 year, Polyplex reported total sale of 7,870 crore and total profit of 900 crore. Against that, company commands a market cap of just 4,000 crore. That translates to price to sale of 0.5 and price to earning of 7. Now, general understanding of valuation suggests that a stock with such low PE ratio is grossly undervalued, isn't it? However, there's a catch. So in this video, I will discuss the reason behind the deep correction in Polyplex share and whether it is a good time to accumulate the share or not. By the way, you'd be surprised to know that at current levels, company offers a dividend yield of more than 8%. And remember that, it is just a small cap company. You hardly find small cap companies that offer such amazing dividend yield. So on the face of it, Polyplex is certainly looking very attractive. But you must understand the reason for correction in share price. That will help you understand whether Polyplex can bounce back or not. Alright, let's get started. Before we discuss the reason for sharp correction in Polyplex, let us quickly understand what is the business of the company. So established in 1984, Polyplex is among the leading manufacturer of plastic films, also known as polyester films, that are used for packaging purpose as well as for industrial usage. For example, in packaging, its products are used in various sectors including sugar and confectionery packaging, frozen food packaging, cheese and dairy, snacks and cookies, tea, coffee, cereal, food staples, soups, liquid, etc. Then within non-food, its products find application in medical and pharma, kitchen, home care, cigarette, personal care, pet food, garden, electronics packaging, textile bags, tapes, etc. It also finds industrial usage in EV battery, window films, electronics, PV solar, screen protection, etc. In short, Polyplex products have multiple usage across industry. By the way, I already created an in-depth video on Polyplex in 2021 where it was at levels of around 1400 and then it zoomed to levels of 2870. However, now it is down to levels of 1200. If you want to understand in-depth about Polyplex, then I would suggest watching that video first. Now coming back to the reason for this sharp correction, if you have seen that video of Polyplex, in the risk section, I clearly mentioned one major risk, and that risk is cyclical nature of plastic film sector. So plastic film sector is cyclical in nature. The reason being that plastic films are essentially a commodity product. Hence, the prices of plastic films are dependent upon demand and supply. If there is more demand and less supply, the prices increase. But if there is less demand and high supply, the prices fall. And it directly impacts the profitability of company in plastic film sector. So when prices increase, the margin increase and hence profit increases. And when prices decreases, margins also decreases and profits also decreases. Now if you observe the operating margin of Polyplex, you can clearly see that volatility in its margin. Company's margins were 10%, then it zoomed to 20%, then crashed to 7% in FY13, then 3%. And then it started increasing to 9%, then 11, 14, 16, 17 and even touched 25% margin. The reason why margins touched 25% in FY21 was because A, there were high demand for plastic packaging due to economy opening up after COVID, and B, there was less supply to meet that demand. Hence, due to high demand and low supply, plastic film prices increased sharply and it resulted in huge profits. Another reason for high margin was sharp fall in raw material prices. The raw material for polyester film industry is resin, which is a byproduct of the petrochemical chain. In fact, the cost of resin is the single largest component in the total production cost. So resin cost is dependent upon crude oil prices. And during COVID, crude oil prices crashed from pre-COVID levels of $60 to below levels of $25. So that resulted in low raw material cost, which means companies were able to manufacture product at low cost, and on top of that, their product prices also got increased due to high demand and low supply. Both these factors resulted in sharp jump in margins, and these margins directly impacted the net profit. For example, before COVID, Polyplex margins were 17% and operating profit was 781 crore. And then margin zoomed to 25%, hence operating profit jumped to 1217 crore. And then we saw crude oil prices jump crazily to touch a high of $125 a barrel. Another important factor is utility cost. Due to Russia-Ukraine war, the energy cost has also shoot up significantly. That has also dampened the margins. Moreover, the demand also got normalized and supply got increased. So that resulted in fall in margins to 20% and recently at 14%. That impacted its operating profit that fell down to current levels of 1084 crore. Please note that we are not considering the net profit because their other income is volatile and taxation is also volatile. By the way, this trend is not only limited to Polyplex. All companies in this sector, including your Uflex, Cosmo First, Jindal Poly, are struggling due to sharp fall in margins that has impacted their profits. Uflex operating margins have fallen from 20% to 13% and its share price has tanked 57%. Jindal Poly margins have fallen from 27% to 14% and its share price has tanked 60%. Cosmo First margins have tanked from 19% to 15% and its share price is also down 60%. As a result, all of them are available at a very low PE multiple. For instance, Polyplex PE ratio is 7, Uflex PE ratio is 2.7, Jindal Poly PE ratio is 2 and Cosmo First PE ratio is 4.8. At first look, these valuations looks crazy low, isn't it? But you need to understand that these plastic films companies have never commanded a very high valuation. The major reason is plastic film packaging sector is cyclical in nature and the margins fluctuates a lot. Hence, market doesn't like to give high PE multiple to plastic companies. For instance, Polyplex 10-year median PE is 7.8 and currently it is at 7. Uflex 10-year median PE is 4.5 and currently it is at 2.7, which is much lower than its median. Jindal Poly 10-year median PE is 4.6 and currently it is at PE ratio of 2. Cosmo First 10-year median PE is 8 and currently it is at 4.8. So all of them are trading near or below their median PE. But here the catch is that PE ratio depend upon earnings. And in the future, if the earnings fall, PE ratio will increase. Now at this point, when Polyplex has corrected 55% and available at a PE ratio of 7 with dividend yield of 8.7%, the question is it a good time to accumulate the stock or there is more pain ahead? Okay, before we discuss the future prospect of company, we have a partner for this video. It's M-Stock from Mirae Asset. M-Stock is offering unlimited trading and investment at zero brokerage. You just need to pay a one-time fee of $999 and include free intraday, free delivery, free FNO, free mutual fund, basically everything free without any catch. And if you open a Demat account with M-Stock, you just need to pay a one-time amount of $999 and your Demat maintenance would be free for life. So you pay a total of $1998 and all your trading and investment is free and your Demat maintenance is free for life. In the last 11 months since launch, M-Stock has achieved a big milestone of 1 million trades in a single day. It is adding one client every 30 seconds and has added over 1.4 lakh clients with over 6 crore trades and 73% active clients and 155 crore of MTF is booked. Since M-Stock is a part of global Mirae Asset Group, it brings 25 years of legacy and experience of 15 countries. So whether you are a trader or an investor, M-Stock is a great trading platform to save a lot of money on brokerage. And M-Stock also offers e-margin facility at one of the lowest interest rates in the range of 7.99 to 9.49%. So do check it out. Link is in the description. To get the visibility of business performance in near term for any company, I always look at the con call transcripts, but in case of Polyplex, I could not find their con call transcript. It seems they don't conduct analyst calls. So I had a look at their competitor Uflex con call to understand the industry trend. And when Uflex management was questioned about margin guidance for FY24, they did not provide the margin guidance. They said that Q4 will set the tone for FY24. So need to wait for Q4 result con call to get the guidance for FY24. Clearly there is uncertainty which market doesn't like and hence giving very low PE multiple to plastic film industry. Now at this stage there are two things happening. First, there is slowdown in global consumption. Due to crazy high inflation in US and Europe coupled with Russia-Ukraine war that has resulted in high energy cost, there is clearly a concern over consumption trend. And a major chunk of Polyplex revenue comes from US and Europe. To quantify this information in FY22, 49% revenue was from US and Europe. So when consumption falls, the demand for packaging sector also fall. And low demand directly impact the volume, that is sales. So until they come out of global slowdown problem, the sales would be under pressure. Second, the margins are under pressure. Due to low demand, plastic film prices have fallen and that has impacted the margins and ultimately the profits. Moreover, due to sharp jump in utility cost and raw material, the margins have remained under pressure. Although the positive news is that crude oil prices have fallen from highs of $125 a barrel to current levels of around $70-$75. But the energy prices are still high. Now at this point in time, we don't have much clarity in terms of what can be the worst margin for Polyplex, because in the past we have seen margins falling from 20% to 3% between FY12 to 14. So that's near-term picture which is clearly looking blurred. Now I was looking at share price trend of Polyplex and found something very similar between 2008 to 10 period and 2020-21 period. During 2008, Polyplex was trading at levels of around 50 rupee, and then by 2010, share price zoomed nearly 9 to 10 times to levels of 470. Likewise in 2020, Polyplex fell down to lows of 300 rupee, and by 2022, share jumped 9 to 10 times to levels of 2800. Now after 2010 high, Polyplex share actually tanked 75% for next 3 years to levels of 110. And so far in 2023, Polyplex is down 55%. If Polyplex follows similar trend, then there can be more pain ahead. Having said this, please note that after 2013 lows, Polyplex jumped nearly 6 times in the next 6 years. And of course, between 2013 lows to 21 high, the growth is 25 times in 8 years. So the point here is that looking at the past trend and cyclical nature of plastic film sector, Polyplex can see further pain ahead over the next 1 to 2 years. But if you have a long-term investment horizon of say 5 to 10 years, then Polyplex can be a good wealth creator. Another very interesting point is dividend yield. Polyplex is a great dividend player. In fact, after the recent correction, company's dividend yield is 8.7%, which is even higher than FD return. However, I have already discussed in the past that dividend yield is not fixed. It depends upon share price at which you purchase the stock and dividend declared. So I had a look at Polyplex dividend history to understand if it is a consistent dividend player or not, and also checked its dividend yield. So first of all, Polyplex has been a consistent dividend player in the last 18 years. In FY7 it was 4 rupee, then increased to 6, 7, 8, then 13 rupee in FY11, but then dividend fell down to 4 rupee, 3 rupee and then 2 rupee. So as the margin fell and earning fell down, the dividend also got reduced. And latest if we see, company declared 165 rupee dividend in 21 and then 104 rupee in 2022, and in 2023 so far company has declared dividend of 85 rupee. Now going forward, if the margins contract further, there can be fall in dividends and that can impact the yield. But one thing is very clear, the company pays consistent dividend and the yield is also good. Even if you look at the shareholding pattern, promoter holding has been constant. Now interestingly, FIs have consistently added stake in Polyplex from 3% to 7%, then 8, 9, 10, 12 and 14. Although recently the stakes have slightly reduced to 13.16%. So FI's confidence in the company is very encouraging. Although DIs are net seller with stakes falling from 6.8% to current levels of 2.8%. Now as far as future growth prospects are concerned, there is a growing trend of shift from rigid to flexible packaging and from loose to packaged product. Moreover, there are also usage in electrical, electronics and new industrial applications like electric vehicle. So there will be continued demand for plastic films. And Polyplex is one of the leading player and fundamentally strong company with more than 35 years of presence in the business, having 2,650 around customers in around 75 countries. Company has a very strong R&D team and is at the forefront of sustainability and circular economy. So a lot of people have this doubt that plastic is a declining industry, but the usage of plastic would not reduce. Yes, sustainable products would be in demand, and Polyplex has already taken various initiatives to recycle waste, save energy and use clean technology to achieve goal of circular economy. Company has recently revamped its recycling project in Thailand. Now there was also news in 2021 regarding Polyplex promoter Sanjeev Saraf selling entire stake at around 1500 crore. The reason for entire stake sale was company's succession planning. Probably it seems Saraf family doesn't have next generation member to take over the business. Hence, they were looking for established institution to take over the business. But it seems that deal did not materialize. Overall, if I quickly summarize, in the next 1 to 2 years, plastic film packaging sector can experience difficult times due to fall in global demand and hence fall in plastic film prices that would hurt the margins of plastic film industry. On top of that, the utility cost is also very high. Although crude oil prices have reduced, that would result in fall in raw material cost, but currently plastic film companies have inventory at higher cost as they manufactured the product when the raw material prices were high. But now that they have to clear that inventory at lower cost due to fall in demand. Having said this, the long-term growth prospects are still looking intact. So only if you have a long-term investment horizon of 5+ years, then you can consider buying Polyplex in a systematic manner. It would offer dual benefit of growth in share price along with good dividend yield. But please note that in the near term, there can be more correction in margins and that can further impact the stock price. But if you are a long-term investor, then you don't need to panic. As far as valuations are concerned, don't just look at P number to decide if a stock is expensive or cheap. In this case, Polyplex along with other peers are available at ultra low PE ratio, but low PE always doesn't mean that the stock is cheap. Likewise, a high PE doesn't always mean that a stock is expensive. Companies are always valued based on their future earning prospect. I hope it makes sense. So this is it for this video. I hope you'll find this analysis interesting. And also, this is a great case study to understand the cyclical stock. If you want me to analyze any stock, let me know in the comments. I'll see you next video. Till then, take care.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.